Hello everyone, Paul here from the Pin Academy. So in today's video, I'd like us to go deeper into market structure. We have spoken about it in a couple of videos, and we have said that simply market structure is when you're looking at turning points. So by turning points, I mean like where the market was moving up, then it reverses to come down, or it was going down and it reverses to go up. These turning points create structure. Now, structure is a combination of both patterns and shapes, right? Just as simple as that. We have spoken about that in a number of videos. But now, today I would like us to go a bit advanced or a bit deeper. Let me just use the word a bit deeper, more into explanation so that you can understand it correctly, right? Because some of you, the questions you're asking are just, you know the things, but I think we just need to do a little bit more explanation so that you can understand them better. Now, we're going to be speaking about two categories. When you're talking about market structure, there are two things that you need to understand, right? For example, you need to know how to identify one, the turning points that we're spoken about. For example, here the market pushed up, then turned to push down, right? But there has to be a reason. Why is the market turning to push down? And why did it stop here? Why did the market stop here? Then started pushing up. And when it pushed up, what way or what manner did it push up? This is an impulsive move, right? So you need to understand those things, how to identify those turning points. That's the basic of market structure. Now, I want us to learn also the other things that we've spoken about, but briefly. One of them is, do you know how to identify pullbacks? What we call pullbacks, right? Then secondly, also you have to know how to identify impulses, right? We have spoken about it briefly. Then also you need to know what we call corrective movement, right? So pullbacks, PB, and then impulsive moves, and then corrective moves. Let's first speak about pullbacks. A pullback is when there has been a breakout happening. For example, we see a market, I'm just using what we are seeing on the screen. We have seen the market breaking this high here that the market had created. But the question is, how did it break? It has broken impulsively. So if it has broken impulsively, we need to see the rule of a breakout. I've spoken about breakouts here is the market has to come back to this point here. Now, you've seen a couple of times that sometimes the market does not reach exactly the point where it broke. There are a couple of reasons. For example, if the market broke with such an impulsive move, breaking more than one or multiple turning points, we have to bring in the concept of impulsive moves, which we are going to speak about second here. So there you have to apply what we call Fibonacci retracement tool, right? Because sometimes the market makers do not want to pick up the people they left behind. Are you getting it? Sometimes the market will do a deeper correction to lure people to go the opposite direction. But sometimes in cases of impulsive moves, the market maker will not want to reach and make deeper corrections so that they can pick people they left behind. Remember, their goal is to make sure that they're taking away more money from the retail traders compared to the money that they're making, because they have to use our money that we are losing with the retailers to close their orders. That's how the market works. It's the bitter truth, but you just have to find a way of working around it, right? So that's what we mean by a pullback. Now, we have said for a pullback to happen, there has to be a break, and we have just explained that. So here there was a break, so we're expressing a pullback. I'm using gold. I'm using this example of gold because I've been speaking about gold ever since it was down there, and you've seen all the breakdowns. In case you've not watched them, you can watch the previous videos. So I like using examples of what I've spoken about or what you've seen before, so that you don't just start saying that this guy is just assuming, maybe he's just replaying something, or no. I want to use the breakdowns that I've done so that you can make much more sense. Why did I do that now? Why I'm using gold is I want you to see, why did I analyze like that? Why did I make that decision? Why did we say that it's going to come back here? This is going to explain everything, right? So we have talked about pullback. Now let's talk about impulse. Do you know what an impulse is? An impulse is when the market is breaking more than one turning point. For example, the market broke this turning point here. Let me just change the color. The market broke a turning point here. This is one. The market broke a turning point here. This is two. I know there are other turning points this side, but I'm just using what we are seeing exactly here. So that the explanation is very simple. I want you to understand the concept. Do not try to assume many things. Just understand the concept. So we have broken this turning point and we have broken this turning point. So more than one turning point being broken, that becomes an impulse. Now, in a structure, remember the market is moving in a combination of structures. By combination of structures, I mean that the market is moving in an uptrend. It's moving while making higher highs and higher lows, higher highs and higher lows. Or it's moving while making lower lows, lower highs, lower lows, lower highs. But of course, the market sometimes is not so perfect like this. Sometimes you'll see it's perfect like this or like this, but most times, 90% of the time, it's not this perfect, right? So it moves in a combination of these things that we're speaking about: pullbacks, breaks, pullbacks, impulsive moves, corrective moves. So that's why I'm first making you understand this, right? So this is what we mean by an impulse. You need to understand it. So whenever you see an impulse like this, that's when you bring in the topic we did, Fibonacci retracement topic, right? Then we have a corrective move. Very important. This one, it happens in both bigger time frames and smaller time frames. If you've been following us on this channel, you know that our smaller time frames are H4 and below. Those are our small time frames. Those time frames are whereby we look for change of trend and entries. Those are what we term as small time frames, right? So what do we mean by a corrective move? So allow me to just clear everything here. I'll just use an example, just slightly, of GBPUSD, right? Let me use GBPUSD because I'm following it up. I hope you guys can see. It's taking a bit forever to load. So you can see here, this is my analysis time frame, which is daily. But remember, we have said that our corrective moves, we can use them in both bigger time frames and small time frames. But if you want to take a trade, for example, we had an impulse here on GBPUSD. Why is this an impulse? Just for learning purposes, again, not to remind you, we have a break of this point, and the market also closed here, breaking 3 turning points, breaking something like a pattern here. So we need a corrective move here, or what we call a pullback. So the pullback can be just a normal pullback, or it can be a corrective pullback. So a corrective pullback means that after this break above, the market creates a mini trend. Are you getting it? It creates another trend. Let's say the market is going upwards, but then when it breaks this level, it creates its other trend here. This is what we're calling a corrective move to pull back. Now, I love this. I love seeing this especially when I'm going to take trades. So I've seen many people are taking already buys on GBPUSD, and I'm very sure you guys have blown. If you're one of them, sorry about that. It means that you've not really been following what we teach on this channel. But if you're to observe the market currently, I've gone to H4, my favorite entry time frame. It's currently making what we call a corrective move to come and test our area of interest. Remember, we're going to speak about area of interest and area of entry. So this is an area of interest because we marked it in a bigger time frame. So why am I calling this corrective? Because you saw we have this is an impulse in a bigger time frame, and you can also clearly see it was an impulse here, right? The market was not creating another trend while it was going up, but you can see here, when it broke above, it has now started creating another trend while coming downwards. What do we mean by a trend? When the market is creating series of lower lows and lower highs, or higher highs and higher lows. You can clearly observe that. I love taking such trades. Now, it will be very easy for me to use this movement downwards to take my trade upwards if the market gives me a change of trend. I hope now you understand what a corrective move is. You can see it's making series of lower low, lower high, lower low, lower high. These are equal lows. Someone may say, hey, but these are equal lows, and then the market currently broke here. So we are testing this point here. If the market can make a low to touch into this area of interest in our bigger time frame area of interest, then this will be one of the very, very, very convenient trades to take, because it has given us a corrective move with that. So impulse, corrective move, then we just use this move for change of trend. Are we together? So I hope you've understood that. Now let's just go back to our gold, because I want to use gold and we do analysis on it after. I know most of us trade gold. So the other category, we have spoken about the first category of how you can identify, how you should be knowing how to identify turning points. I've also spoken about how you should be knowing what pullbacks are, impulsive moves, and corrective moves. So by now you should be understanding that. Now, the second thing that you need to understand is you need to understand what top-down analysis is. I don't mind what type of trader you are. Maybe you trade SMC, maybe you trade ICT, maybe you trade market structure, maybe even if you use indicators. So no matter the type of trading you're doing, you need to understand what top-down analysis is using your convenient method. I'm not saying you should use my method of trading. It may not be comfortable for you. Whatever you're using that you're comfortable with and you understand its rules. The most important thing is understanding the rules of whatever method you're using. So if you understand its rules, use its rules to make sure you're looking at analysis in a couple of time frames. And those time frames I've spoken over and over, you should have minimum 3, but you can have up to 4. 1 for direction, 2 where you get your structure, and thirdly where you get your entry. The fourth one is by the way, you may use it or not, is where you do your refining from. Are we together? So you need to understand top-down analysis in case you're to grasp what this thing we call market structure, especially if you're using price action like what we base on. We don't focus so much on indicators, right? So top-down analysis. Then secondly, you need to know what is my area of interest, what is my area of entry, and their importances. I'll give you an example. You guys recall we spoke about gold when we just made this W here. My internet is a bit slow. I don't know why. Sorry for the waiting. So you guys recall that we said when the market made this W here, you can check the analysis we've been doing. If you've been following keenly, we said after W, what do we expect? A retracement. Now, I've spoken about this a couple of times. I see questions still coming in. That's why I wanted us to make and understand this concept once and for all. If you've been following from the first minute and you didn't skip, the problem is you guys keep skipping videos, then you find concepts and you start asking questions in the comment because you skipped, right? So we say that when the market breaks a structure, what do we expect? A pullback. But in this case, the market, this is not a pullback. This is the same move, right? So when the market makes this push up and breaks this structure, this neckline, and the rules of the W are very clear that once the market makes a W, we expect the market to come back. This is what we expect the market to do. So the market broke above, came back, right? So this is, we spoke about this and we said that this move here was invalid. I know it tested. Yes, it is a test, but this is not a proper test, right? I call them invalid or improper tests, right? So the market came back and tested it. So this is what we call, this becomes your area of interest because you're marking it in a bigger time frame. Any level that you mark in a bigger time frame is what we call area of interest, right? Your analysis time frame or structure time frame, or even the direction time frame or structure time frame, what I term as analysis time frame. Whatever you mark, S slab, O level, or horizontal, whatever the technical tools that you're using to mark where you expect the price to come to, that will pique your interest. That becomes your area of interest, right? So you must first have interest before you take a trade. It's just like for the boys' side, when you're approaching a lady, you need first to pick interest in the lady, right? Before you approach her. That's the same thing in the markets. You first pick interest before you approach, right? You don't approach without interest. Are you getting it? So it's the same thing here in the market. First have area of interest before you have the area of entry. Entry is like the approach, like I want to enter the market now, right? So we had this. Now, let me just take back a replay tool slightly here. Now, when you come back to one of my structure timeframes, I prefer using weekly because I normally hold trades for I don't like trading with a lot of pressure, right? My internet is a bit slow. You guys will forgive me about that. So you can see the market has to come back and touch into our area of interest. And I emphasize this, as long as the market does not touch your area of interest, right? So it means that you should not take a trade because you've not picked, it means you've not picked interest. I've just repeated this. You have to first pick interest before you approach. In case you find it difficult, just as if you're male or female, even females can use it, just imagine that there is someone that you like, right? You first like the person, or you first crush, or you first admire, all those terms before you approach. So it's just the same as a trade. The trade you should first love the trade. You should first like the trade. You should first crush on the trade. How do you crush on it? By tapping into your area of interest. So what you have to emphasize is first to learn how to mark the area of interest properly. Are we together? If you don't understand that, then you're going to a very, very dangerous road. So this is the area we're interested in. So meaning that it means that now this high here is invalid to us. We're not going to use it. Are you getting it? Please make sure that you follow along because now we're doing analysis of gold for those who trade gold. So we expect the market to touch. And now the moment the market touches there, because these are equal highs, so meaning that we shall be interested in this level here. If the market touches, if they ain't touch, that's when we can use this high here. But the moment the price, this movement touches here, because we have an M now at the neckline, we talked about how this was a neckline. We expect the market to push down here, right? It's all in the previous video. So allow me to just replay. Remember, this is a learning purpose. And then we also do the current analysis. My internet is a bit slow. Bear with me. Okay, you can see now here the market touched. So since the market has touched now, we identify our high, the high that gave us our significant high. I've spoken about this in a previous video. You can look at how to mark significant highs or valid levels, right? Highs and lows. You can look at it. So it has touched this level. Now, if you're an intraday trader or scalper, or even if you're going to hold for some time, you can look for change of trend here to go here. Are we together? So I've said that you can, when market touches your area of interest, you can go to your entry time frame to look for pullbacks, maybe there are breakouts and the rest, so that you can look for change of trend, right? We spoke about that in the first category. So in this case, you can just come to here, since that's touched our area of interest, then you look for the change of, we have spoken about that. In this case now, here is the last low that the market created that gave us this push higher. So this area here, once the market breaks above it on the pullback, We spoke about this here. You can look in the previous videos. When it pulls back here, then you can take your trade up to this level here, right? So, but that's not the issue that we're explaining here. I just want you to understand the aspect of area of entry and area of interest. So remember, we wanted the price to first touch our area of interest. Now that has touched our area of interest, now we have identified this as our area of entry. So meaning that I'll only take my trade here when the market comes back. Let me just change this color. When the market comes back into this, are you getting it? So on a pullback, that's when I take my trade. Getting? So here in this case, the market gave us a valid pullback, then I can be able to take my trade. My stop loss will just be below the rules that may be used for stop losses, maybe untested levels. That's what I love using. Then you can take your trade. So I hope you guys now understand area of interest and area of entry. First, we spoke about you must be able to do top-down analysis, and then also how to be able to use area of interest and area of entry. Now, I've just given you the difference of the both of them, right? So let's continue building up on our analysis. I want us to build up on this past, and then until we go to the current information. Then we can also conclude on our analysis of gold, right? So we have spoken about that. Now, lastly, we speak about change of trend. Not lastly, this is the second last thing. I've just briefly hinted on it here. If the market, for change of trend, the market has to first touch into your area of interest. Then you switch. When the market touches into your area of interest, which you marked in the bigger time frame, switch now to your entry time frame. Now, my favorite is H4, and I prefer using it to mark anything, any level that I'm going to use to consider taking trades. Even if I'm going to use a different time frame like H1 or minute 30 or minute 15, I prefer marking the levels starting from H4. Any small time frame markings of mine, I prefer using H4, but you can use any of your own, right? So first, before you start even thinking about change of trend, you have to first make sure it has touched your area of interest. Are you getting it? So after touching your area of interest, and then we can now say that we're looking for change of trend. Are you getting it? Change of trend is when you identify that the market maybe has been moving lower low, lower high, equal lows here, lower high, lower low, retest this point here, then it starts shifting to make higher highs and higher lows. This is what we mean by change of trend. This process of it shifting like this is what we call change of trend. Are we together? So you must be able to know that. Then when change of trend happens, for example, we identified this area here as our area of entry, meaning that we identified change of trend here. So meaning this is our area of entry, meaning that our last point is to take our trade. I know most of you love taking trades using candlesticks. It's what most of you have been introduced to in the industry and what. Yeah, if you're okay with them, that's good. Personally, I'm not a very big fan of them. I use candlesticks just as a communication language in the market, and I prefer to use them for momentum because I so much use momentum to take my trades, and even in most cases in analysis. Just like you've seen, whatever we post here is how exactly we trade, and we show you exactly everything. So if you're not very lazy, you should be able to at least practice, backtest, and you grasp everything. So remember that we had marked everything. So I've already spoken about the first category, but you have to learn how to identify turning points, pullbacks, impulses, corrective moves. Then we came to the second category whereby you're supposed to do a top-down analysis. You're supposed to understand area of interest and area of entry. And then you're supposed to also come to terms with change of trend, and then you take your entry. So if you put all these things together, you won't be 100%. I can't guarantee you to be 100%, but your winning rate will be more than how you've been losing, right? So now that we have put all that together, now let's go back to monthly. So let's finalize with the breakdown of gold. So I'm just going to cancel out this replay tool so that we just do the current price of gold. So when I remove everything here, you can clearly see the level that we had marked is just this one here. So I do expect at least gold to come back. Why do I have these levels here? Remember, I said that this was our first area of interest whereby I wanted the market to come and retest. It was a neckline in the monthly. And then this is the level that gave us a pullback, right? And then now we have a W, resistance. Now we broke above. So this is an impulse. Remember in the previous analysis video, I said that when there's an impulse, what do we want to see? We want to bring out our Fibonacci retracement tool. Then you mark it there. So this blue level is aligning perfectly with our golden ratio. As long as golden ratio is not broken, sometimes also it can stop on fast golden ratio, so I'll mark it, right? So these are the areas where we're expecting gold to pull back. Now, I want you to watch how gold pulls back. Is it going to be corrective, or is it going to be just a normal pullback before you can look for change of trend? to take your trade. Now, what are these levels that we have marked? This was our first area of interest that we have used. So we're not interested in it. We're now interested in this area of interest, this one or this blue level, or even it can just be this area here like this. As long as gold does not break below this blue slab, because our golden ratio is just around here. You saw it in the Fibonacci when I drew. So gold can correct here, either into this level or even up to this blue level. Watch how is it correcting. Then when it touches your area of interest, switch to your entry time frame and look for change of trend. Those are the steps that I've just given you, right? And if you're to put them together, you realize that you're actually doing a top-down analysis because you've looked at monthly direction, weekly structure. Then H4, that's when you can, when it touches, don't switch before it touches your area of interest. Remember, in case you find it confusing, just take it like this, that before you approach a girl or before you approach a guy, you need to first have interest. You need first crush on the person. I hope that will make it easier for you to remember. Before it does that, it's better you leave. Just let it be, right? If it doesn't touch, let the trade be. There are very many other pairs that you can be looking at. There are very many. I just have a few here, but there are very many pairs that your brokers offer, no matter the broker you're doing, right? So I hope this has made much more sense, and you guys have seen what I'm looking out for gold. I'm expecting gold to pull back here before we continue a little bit higher. I'm expecting gold to reach at least 2,300 or 2,500 in between there. But of course, let's see what price. We just have to react to it. If it breaks below still, we shall have an update on it and you guys will be able to see it. So that is it. I hope you guys got value out of it. It was your first time coming across. Consider to subscribe. And if you got value, don't forget to like the video so that it can go to very many people who could be interested also.